This is On The Charts with Nick Reg, your Australian stock market update, highlighting stocks on the move so that you can invest with confidence and success.
The information in this podcast is general advice only and does not take into account your personal situation. Please consider if it is appropriate to you and consult a licensed professional before making any investment decisions. The information provided is believed to be accurate at the time of recording.
Welcome to the On The Charts podcast, episode 197 for Wednesday, 17th of May, 2017. Today is day 3 of our Big Picture Week, and it's this week where we take a look at the very long-term outlook via monthly charts to assess the correct positioning for your portfolio over the coming years. Our analysis tonight will focus on gold, oil, copper, as well as some of the big blue chip names in Australia. Last night in the US, both the S&P 500 and Nasdaq crept to new highs early in the session, but the S&P wasn't able to close higher. Momentum persists from strong corporate results, yet the grind higher remains very low volatility. This is actually the longest stretch that the S&P 500 has traded less than 0.5% range since 1969. It seems a waiting game for the next market mover, whatever that may be. It could be a Trump administration tax reform, but really who knows. Media continues to focus on the VIX and suggests it's a prelude to some major downshift. This wall of worry may continue to actually propel prices higher. Unfortunately, it wasn't a good day for the Australian market today. In economic news, ABS data showed real wages decline for the first time in nearly 3 years. Private wage growth stayed at a record low of 1.8%. Consumer sentiment has also failed to be boosted by the budget. At least that's the conclusion from Westpac chief economist Bill Evans. Whilst the headline figure declined only slightly, there were some larger moves worthy of noting. Confidence in housing and house prices dropped sharply. In company news, Wesfarmers has ceased to go ahead with their planned listing of Officeworks, citing poor share market conditions for the IPO, and shares in Wesfarmers fell 1.3% today on the news. CYBG, the Clydesdale Bank spin-off, fell heavily after releasing poor earnings in the UK overnight. And Australian banks continue their declines after a few days of pause. All banks today fell about 2%. The acceleration of the downside momentum in the banks should be worrisome and suggest no near-term reprieve will be seen. Shares in Certex also went into a trading halt today after the company assesses recent clinical test data prior to a study being released by the American Society of Clinical Oncology. Shares in the liver cancer company have been well and out of favour for the last few years, falling some 62%. And as a rule of thumb, the direction of the trend tends to determine the outcome of the news release. So if this news is not good tonight, we expect a big gap down in Certex when they reopen. NIB also fell 9% after the broker downgrades, and the only real bright spot was materials, with Fortescue taking a small bounce after a broker upgrade. At the close today, the broader market was 1.1% down. Having a look at a few stocks, individual stocks, Tabcorp has been performing well so far this year. The gaming and wagering company is currently undergoing a merger with Tats Group, which is being sought after by the Pacific Consortium, whom offering $4.21 per share. Analysts aren't overly convinced of the merits of the consortium takeover versus the merger with Tabcorp, and on the basis the merger will go ahead, believe Tabcorp is actually undervalued. The company's also signed a 5-year wagering agreement with the Australian Hotels Association for exclusive access to New South Wales hotels, which account for about $1.6 billion in annual TAB turnover. Since early 2015, the share price has been stuck in a range between $4 and $5, with the upper boundary of that range recently tagged. What's taken our interest this time, however, is the pattern progression to this level and the preceding 6 months. Price action has become increasingly impulsive lately, meaning trending strongly rather than being choppy, as it has been the case over the last 18 months. We expect some ongoing weakness in the coming weeks, which is very typical for this stage of the trend, and may see prices fall back to 440 or maybe even 450 zone. If this decline continues on low volume and shows sign of abating, a buying opportunity may arise, which in turn could lead to a more sustainable test of that upper boundary and perhaps seeking blue sky beyond it. And for those who like to allocate money beyond Australian shores, either directly or via many of the ETFs now available, then the Japanese Nikkei is worth a look. Global chart research analyst Scott Goddard will take a closer look at the Nikkei and the Hang Seng next week, but both the near-term and very long-term outlooks are positive. The Nikkei is currently trading around the 20,000 level, having returned some 22% for investors over the last year. We see further upside in the coming months, with prices expected to continue to push towards a major zone of resistance between 21,000 and 22,500. This zone has kept a lid on prices since 1996. Now, you didn't hear that wrong. For the last 20 years, pattern progression off the mid-2016 lows around the 15,000 level has been textbook, and it does suggest more strength in the coming month or so. My name's Nick Raj. Don't forget to check out our 2-week trial, especially this week with the big picture. Head on over to thechartist.com.au and hit the green button for immediate access. I'll see you on the charts tomorrow.
On the Charts with Nick Raj, brought to you by The Chartist. Join Nick and the team at Noosapalooza Trading and Investment Conference, 20th and 21st of July in beautiful Noosa, Queensland. Visit thechartist.com.au and click on Noosapalooza in the menu for details.